Question for you. Is it smarter to invest a little bit at a time with dollar cost averaging, or just dump all your money at once with a lump sum strategy? Because if you're sitting on cash or even just wondering what to do with your paycheck every month, this one decision could cost you thousands of dollars over the long run. The numbers emphatically say one way is clearly better than the other, but I'm going to tell you why I prefer the complete opposite. So stick around and we can go over both and you can decide which one is better for you. So let's get into it. First up, dollar cost averaging. What is it? Well, it's simple. You invest a fixed amount of money, say $500, at regular intervals, like every week or every month, no matter what the market's doing. When the prices are low, you're buying more stock because it's cheaper. When the prices are high, you're buying less stock because the price is actually now more expensive per share. Now, over time, that could lower your average cost per share from a VWAP or volume weighted average price perspective, particularly if the market isn't just going straight up. Now, it's automatic, it's consistent, and it takes emotion out of the equation. So, is it better than lump sum investing, which essentially is taking all your investable money, whether that's 1K, 100K, or even over $1 million, and investing it all at once, right into the market? Now, the answer may surprise you. Lump sum investing outperforms dollar cost averaging about 2/3 of the time. According to a 2012 study done by Vanguard, lump sum investing outperforms dollar cost averaging about 66 to 70% of the time by an average of about 2 to 3% in total return over a 10-year period. Now that 2 to 3% might not sound huge, but over 10, 20, 30 years, it compounds significantly. Even after 10 years, if you invested 100K in the same underlying assets, the outperformance can be significant. You can see the lump sum strategy here capturing all the gains because they were fully invested, while the DCA strategy missed out on the gains by spreading out their risk and not being fully invested. That 3% annual difference results in $57,000 after just a decade, purely from compounding. Now you can visually see the difference in the blue shaded area of the chart. That's because markets historically go up over time. There is a long bias to the market. The earlier you're in, the longer your investment is able to compound. Now with dollar cost averaging, you are leaving cash on the sidelines, so it's not yielding anything other than the interest in your brokerage or your savings account. So your investment is not able to achieve compound growth at its full potential. But this is where it twists a bit. Dollar cost averaging isn't about maximizing every dollar. It's about building a system that helps you actually take action. Because let's be honest, how many people stay on the sidelines, scared to get in or waiting for the perfect entry price, stricken with the case of analysis paralysis? In this case, dollar cost averaging wins because behavior beats math. So how much should you DCA every month? Well, if you can swing it, the professionals advise about 15 to 20% of your gross monthly income. But the real answer is whatever you can afford. What you cannot afford to do is stay uninvested and sitting on cash. Automate it. Make it boring. Why? Well, because boring gets rich. And if you're investing through a 401k or an IRA every month, you're already dollar cost averaging. You're winning, despite the sea of red you've been swimming in the past month. Stay calm, carry on, keep investing on a regular basis, because that is the key. So let's go over a couple examples. Example one, this is one where dollar cost averaging works perfectly. You invest $500 a month over 6 months. Now the market dips midway through and then rebounds. You bought more shares at the low and less at the high, and when prices rise again, your average cost is lower and your gains are higher. See, that's the perfect DCA setup. Now let's go to another example. In this example, dollar cost averaging will underperform lump sum. So you take the same $500 a month, but the market keeps on rising. Each month, you're buying fewer and fewer shares. If you've invested a lump sum up front, you'd have earned more. So in this case, both strategies are making money, but lump sum is the clear winner. Now, the big question I get asked all the time is, do I have to stick to regular intervals? Or can I just buy on dips? So technically, dollar cost averaging is all about consistency. But yes, if you're not watching every tick of the market, then I would tell you, stick to the game plan. Invest the same amount every month, eyes closed, left foot, right foot, carry on, that's it. But if you're a stock jockey and you're always tuned into current events and you're trading consistently, then no, I would suggest a more hybrid approach. And this is kind of more of the camp that I would fall in. I call it tactical DCA. So you invest a set amount each month and you keep a little cash on the side. And when the market drops 5 to 10% or more, you get in there and you buy the dip. You get the discipline of dollar cost averaging and the upside of opportunistic buying. So you don't just fall into the trap of waiting around for the perfect dip that never comes. That's called market timing, or being Dr. Wall Street. And it's where most people lose by missing out. So is dollar cost averaging the smartest way to invest? Well, for me, it makes things mechanical and habitual with less emotion. You don't have to worry about timing. And if you're a new investor, it's the perfect way to safely and comfortably get involved with investing. Again, though, it depends on you. And if you're nervous about volatility and you need structure, then dollar cost averaging is your best friend. Now, if you've got a lump sum of money that's sitting around and you've got the stomach for some ups and downs, the statistical data is behind you and says, go all in. My view here is you have to know what the theme of the market is. Now, if it's a bear market or volatile market, then dollar cost averaging is a better option because you're investing on a regular basis and you're catching those dips. If the market's on a bull run, then lump sum investing is the best bet because it gets you money in the market quickly with momentum, and then the power of compounding interest can begin. But whatever you do, pick a plan and stick with it, because that's how real wealth is built. Thanks for watching. I'm Seth Moran. I spent 20 years on the street professionally trading a shit ton of stock, and now I try and help everyday investors like you guys take the fear out of investing by answering the questions you want to know, but you're not sure how or who to ask. Now, if you like the vibe, subscribe for similar type content distributed weekly and hit that like button. It does help me build and grow, so I greatly appreciate it. And if you've tried DCA or you're still sitting on cash, wondering if you should go all in or not, drop a comment below and let me know what you're trying to do. And don't be afraid to fire any other investment related questions you might have down there as well, especially if there's something that you want me to do a deep dive on for a future video. Remember, kindness is the rent we pay on earth, so do something nice for someone. See you in the next one.